Humans are stupid. Human error is the cause of 94% of vehicle accidents today. So what if we took away the human? That's what I want to talk about today in my video on investing in self-driving cars. Let's talk about why you're here. You're either a nerd who's interested in investing in themes with the potential for high growth, you're a nerd who just likes to talk about stocks, you're a nerd who likes to talk about technology, or you just saw a video on your YouTube homepage and clicked on it because you were bored. Either way, you're a nerd. About me, I'm a retail investor and I've been working in finance for around a decade. I am a professional financial advisor, but this is not financial advice. Why is it not financial advice? Because nobody should be telling you which stocks to buy. Everybody's investing journey is different and everybody's financial situation is different. Therefore, I don't believe in recommending or picking stocks for people. What I do like to do is to talk about stocks and give people the opportunity to research themselves. So any stock that I talk about, you should be doing your own research on and coming up with your own conclusions. The schedule for today is we're going to talk about the bull and bear case for autonomous driving. We're going to talk about LiDAR, what it is and how it works. We're going to talk about LiDAR stocks and two other autonomous driving stocks that are not LiDAR. We're going to talk about Tesla briefly because we have to. And we're going to talk about a stock that I'm avoiding like the plague. If that sounds interesting, then stick with me and here we go. The bull case to autonomous driving is pretty easy to understand. If you're like me, you don't like maintaining your car and you don't like sitting behind the wheel for hours on a long road trip. Autonomous driving takes care of both of those issues. With autonomous driving, if robotaxis take off, you won't even need to own a car. You can simply call a car whenever you need to go somewhere. It will show up without a driver, take you where you need to go, drop you off, and go drive around and pick up somebody else. It'll be like Uber without the Uber driver, so you don't have to make any awkward conversation. It sounds really nice to me. In addition to that, there's safety to consider. Like I said, humans cause 94% of vehicle accidents, so we would reduce vehicle accidents with a perfect robot by 94%. The robots are going to take a while before they achieve that perfectness, but we're still going to see increased safety on the roads, taking out drunk driving, for example. We're going to have increased access to mobility. So think about senior citizens who may not be able to drive anymore. They're finally going to be able to get place to place again, assuming they can use their smartphone to call an autonomous vehicle. We're going to see reduced traffic because these vehicles are going to be optimized to know exactly how fast to go and how to avoid traffic. We're going to have fuel efficiency because they're going to accelerate at the perfect amount because it's a robot. And we're going to have parking optimization. You think about events where there's huge parking lots with all these cars. That's going to be cut down so much because these autonomous vehicles are going to drop people off at, say, a concert and then just go somewhere else. There won't be this huge parking lot. You can be dropped off right at the front. It will be very nice. So that all sounds wonderful, but what's the bear case? The bear case is, of course, regulatory hurdles. That is the biggest issue for self-driving cars. Even if the technology catches up and does work and is viable, we're going to have to figure out some kind of regulation for self-driving cars. There's also extreme conditions to consider. Where I live, it snows for a lot of months of the year, and the roads can get very snowy and very icy. Even the best drivers struggle in snowy conditions, so to train a robot what to do in these icy and snowy conditions is going to be very difficult. There's trust with autonomous vehicles. A lot of people don't trust AI, which I understand. So autonomous driving is a form of AI, and there's going to be people who need to get comfortable with that before we see mass adoption in autonomous driving. There's cybersecurity to think about. So an autonomous vehicle, like I said, is a robot at the end of the day, and these robots connect to a system, a grid, and this grid could be hacked. So we definitely want to make sure that we have the proper cybersecurity in place so that we don't have somebody hacking in and controlling people's autonomous cars. That would be very dangerous. There's also the issue of liability and legality. Let's say an autonomous vehicle does get in an accident or does hit something or damage something. Whose fault is that, right? Because the autonomous vehicle is not going to be able to go to court. At the end of the day, somebody has to be held responsible if there is any kind of liability. Shut up and give me the stocks. Okay, let's talk about LiDAR. So what is LiDAR? So in the background of this slide, you can see this very pretty rainbow picture with some palm trees. This was generated by LiDAR. So essentially what LiDAR is light that shoots off of objects and bounces back so that a computer can make an image of its surroundings. It's kind of like a bat. So you know how a bat uses echolocation to detect things because they're blind, essentially? What LiDAR does is the same thing, but instead of sending out a sound signal, it sends out a light signal. LiDAR systems emit laser beams, which are pulses of light. They hit objects in their path and bounce back. The LiDAR system calculates how long it took for that light beam to bounce back, and using the speed of light, it determines the distance to the object based on the time of flight measurement. So what it does is we'll repeat this process quickly, scanning its surroundings and creating a dense set of distance measurements, forming a 3D point cloud, and that's what you saw on my last slide with the rainbow palm trees. This point cloud is used to create detailed and accurate maps or 3D models of the environment. So essentially what LiDAR does is detects what is around an object, and if this object is moving, then the LiDAR systems refresh over and over and over, and that's what allows an autonomous vehicle to quote-unquote see. So let's talk about LiDAR stocks, because there are stocks out there that produce LiDAR that you can invest in today. Ouster, ticker symbol OUST, specializes in digital LiDAR. It's used in autonomous vehicles, but also robotics and industrial automation. Innoviz, INVZ, has a partnership with Volkswagen. They develop high-performance LiDAR for autonomous vehicles. AVA, ticker AEVA, focuses on FMCW LiDAR, which is frequency-modulated continuous wave LiDAR, and they're aiming to produce long-range, high-resolution sensing. Luminar is the biggest stock of the bunch, ticker LAZR. They're known for their advanced LiDAR for autonomous vehicles. AI, with a very clever name, AEYE, combines LiDAR and AI, right, thus the name, to enable dynamic perception and adaptive scanning for applications such as autonomous vehicles. And Hesai is the new one, ticker is HSAI, and they're a Chinese LiDAR company known for producing LiDAR sensors for applications like autonomous vehicles, drones, and smart cities. So one thing you can see is that all of these LiDAR companies are very similar, but sometimes their applications are different, right? Autonomous driving is not the only use of LiDAR. We also see LiDAR in other robotics and industrial automation niches. My thoughts on LiDAR stocks is that I don't like them, and here's why. They're almost all SPACs, and I don't trust SPACs. So what that means is a SPAC is a special purpose acquisition company. They are essentially a blank check company where they come to market with a bunch of money funded by the SPAC founders, and they look to take a company public that might not otherwise be able to do so. On the surface, that sounds really nice, right? These small companies can finally get going public, but I don't like that. If a company is not ready to go public, they should not be going public. They shouldn't be going through the back door through a SPAC. To me, that creates a lot of uncertainty because you get these companies that really should not be trading, that are trading on the market, and we've seen how their performance has been. Most SPACs down something like 90%. My other thoughts on LiDAR stocks, setting aside my opinions on SPACs, is that their margins are horrible. All but one of those stocks, perhaps all but two of those stocks that I talked about in the last slide, have negative gross margins, which means that they're selling a product for less than it costs to make. So if the cost of a product, let's say, is $10 to make and you're selling it for $7, that's a negative gross margin, which means you don't really have a viable business. It's also a very competitive market, as you saw. Besides those public companies, there are private LiDAR companies out there. So there's a lot of competition here, and LiDAR is very, very capital intensive. So it's expensive to produce, and it's going to be really difficult to turn a profit someday because of these high expenses associated with LiDAR. So what do I like? If I don't like LiDAR stocks, let's talk about two stocks that I think are viable investments in autonomous driving today. Before I do that, though, I have a quick shameless plug. Please like and subscribe if you don't mind. I am a new channel, so your support means so much. Okay, back to the stocks. If I don't like LiDAR stocks, what else is there? Allegro Microsystems, ticker ALGM, I think is a great picks and shovels play for the autonomous driving revolution. So Allegro focuses on developing and manufacturing sensor and power semiconductor technologies. They provide solutions for applications such as automotive and industrial systems, including sensors that contribute to advanced driver assistance, or ADAS, and electrification. So this is a picture here of an Allegro Microsystems sensor. That's what they look like. They're just a very small piece of technology. And they have 4 products that I think lend themselves very well to autonomous driving. So the first one I want to talk about quickly is their 3D magnetic position sensors. So you can see this picture on the right. It uses a magnet, that's the N and S, north and south. in order to determine what direction a machine is facing. So it can be utilized in applications such as motor control and positioning. They can contribute to precise control of various components within an autonomous vehicle. That's important, right? Because we need to know what's going on in our robot in order to control the robot. Another product that I think will be very important for not just autonomous driving, but also electric vehicles in general, is their current sensor ICs. And ICs are just a fancy way of saying chips or semiconductors. These are used for monitoring electric currents in different systems, and they can be used to optimize the efficiency of an electric or autonomous vehicle. Finally, we have two products here. That first one that looks like a spider is a motor driver IC, and this is designed to control the motors used in autonomous vehicles, very, very important, contributing to functions such as propulsion, steering, and braking. They also offer angle sensors that can be employed in applications where precise angle measurements are required. These sensors can be beneficial for tasks such as steering angle sensing and position feedback on autonomous vehicle systems. So here's a picture from the Allegro Microsystems website. You can see that these two chips pictured are going to help these vehicles to quote-unquote see the other vehicles around them. So in order for a vehicle to see, it needs to sense what is going on, and in order to sense, you need a product like the products that Allegro creates. Let's talk about Allegro's financials now that we know the technology behind it. They are profitable with 15% year-over-year revenue growth. They have a wonderful balance sheet. They actually have less debt than they have cash, which is wonderful. They could take all their cash today. Well, not all their cash. They could take their cash today, pay off all their debt, and still have cash left over to run the business. They have 56% gross margins, which is wonderful for a hardware company. At the end of the day, Allegro is selling bits and bobs. They're selling hardware to companies that need sensors. So to have margins above 50% selling hardware is really great to see. I imagine that as time goes on, other companies that sell sensors will provide competition to Allegro and will eat into Allegro's gross margins. But for now, to see that they do have wonderful margins is great to see to me. They have low operating expenses, which means that they keep a lot of this gross profit. They're also trading at 5 times annualized sales. And for a tech stock, it's not uncommon to see valuations in the double digits. So a software company might even trade at 20 times annualized sales if it's a very robust SaaS company. For a hardware company, 5 times annualized sales is a bit more reasonable, but it's still on the low side when you look at other semiconductor companies. All right, so that's Allegro. I've talked your ear off on Allegro. Let's talk about my other self-driving company that I think is viable today, and that is Mobileye, ticker MBLY. They are an Israeli technology company specializing in advanced driver assistance, or ADAS systems, for autonomous driving. They develop computer vision and machine learning technology to enhance the safety of vehicles. So that's their biggest selling point right now, and I think it's going to be the bridge between manned vehicles and unmanned vehicles. Their two main products are SuperVision, which I'm most excited about. It's their most advanced driver assist system, providing hands-off navigation capabilities for autonomous vehicles, while still requiring the driver's full attention and eyes on the road. Their other product is their IQ chip, EYEQ. Mobileye's proven leadership based on IQ system chips is used in more than 50 vehicle manufacturers, including Porsche. And essentially, IQ is the brains of self-driving. It's a little chip that supports complex computation and intense vision tasks while still meeting the performance targets. So let's talk about those first, the IQ chips. So a system-on-chip, or SoC, is essentially a semiconductor that incorporates all or most of the components required to power the whole machine on a single chip. So like I said, it's the brains of self-driving. It's like having an entire computer system on one chip. The product that I'm more excited about is Mobileye's SuperVision, which is actually enabling autonomous driving in a small scale. So what SuperVision allows is, let's say someone's cutting over into a car's lane, it will accelerate or decelerate to avoid collision. It'll also avoid front and rear collisions, allow for lane changing, autonomous lane changing, and parking autonomously. Here's a picture from Mobileye's test. As you can see at the bottom, this is an autonomous vehicle. There is a driver in the car, but the driver's hands are not on the wheel. The wheel is turning by itself. And what we see here is that there's a pedestrian. What happened is it's a moving truck, and somebody actually got out of the moving truck and started walking on the road. Yes, they're out of the lane, but they are on the road. Mobileye's technology sensed this person using their LiDAR cameras, and the car actually avoided this person. It swerved just the tiniest bit to avoid this person and give them the right of way so that they could walk around. It's very, very interesting technology. So Mobileye's financials I don't like as much as Allegro. I'll tell you why. The biggest thing is that they have $10 billion of goodwill on their balance sheet. So what does that mean? If you're not an accounting nerd, you might not know what goodwill is. It's essentially when a company acquires another company, whatever they overpaid becomes goodwill. So company A buys company B for $15 billion, let's say. Company B has a book value, meaning their assets minus liabilities, of $5 billion. So how do you record this extra $10 billion? That's goodwill. The reason that I don't like goodwill is because it often gets written off, which looks like a massive loss. So what we see is that a company will overpay for another company, hoping to see some synergies in the two companies, and will eventually have to write off what they overpaid because they realize the company they acquired is not worth what they thought. So how did Mobileye get so much goodwill? What happened was Mobileye was its own independent company and was then acquired by Intel, the semiconductor company, and then was spun back off from Intel. So when Intel acquired Mobileye, they acquired Mobileye with $10 billion of goodwill, and then they stuck Mobileye with that goodwill when they spun them back off. So yikes. What I think will happen is that Mobileye will have to write off some of this goodwill, which will send shares down. Again, I can't predict the future, so I don't know this will happen, but I think that is a risk. One nice thing is they're 50% gross margins, so very similar to Allegro. I like to see 50% gross margins on hardware companies. They are expecting negative revenue growth for the first half of 2024 temporarily. We did see 18% year-over-year revenue growth prior, which is nice. But what happened is that they had an inventory issue where they supplied too much inventory that did not all get sold. So now they are not selling as much for the first half of the year. They expect that to normalize halfway through the year, but that is what sent the shares down recently. They are trading still at 8 times annualized sales, which is significantly more than Allegro. The reason for that is that Mobileye is a somewhat recent IPO, so I think there's some IPO excitement priced in. Also, Mobileye is a bit more of a pure play self-driving company, whereas Allegro has applications in other industries. So I believe that the excitement around self-driving is giving Mobileye a higher valuation. One thing I don't like to see is that Mobileye is spending a lot on R&D. They're spending about 90% of their gross profit on R&D, which means that they're going to have to really monitor their SG&A, which is selling, general, and administrative expenses, in order to keep a focus on profitability. They are currently at a lower valuation than their IPO. When they IPO'd, they had a valuation of 9 times annualized sales, and they currently have a valuation of 8 times annualized sales. So if you are interested in Mobileye, if you bought today, you're essentially getting the lowest valuation that you've been able to get since their IPO. Of course, we have to talk about Tesla, and I'll keep this brief because everybody talks about Tesla. But Tesla's autopilot is their current self-driving option. It's an ADAS, or advanced driver assistance system, that includes features like adaptive cruise control, lane centering, and automatic lane changes on highways. Very good stuff. But what really is the game changer for Tesla is their full self-driving, or FSD technology, which includes autopilot, which is automatic driving on the highway. That's cool. And smart summon, which is vehicle retrieval. So it'd be very nice if you don't even need to valet. You can just have your Tesla pull itself up when you're ready. Tesla, of course, has advanced hardware and over-the-air updates going for it. So you don't need to take your Tesla into a physical service center. It will update automatically. And they also have an interesting vision-only approach. So we talked about LiDAR earlier. Tesla does not use LiDAR. Rather, they use cameras and neural networks and machine learning to process data. So what about trucking? That was the question that came into my head when I was researching autonomous driving. You would think that semi-trucks would be the first thing to go autonomous because at the end of the day, they're staying on the highway for most of the time. It's going to be a lot simpler than autonomous driving in a rural area. So there is actually an autonomous trucking company that does trade publicly, but it sucks. That company is too simple, and the reason I say it sucks, first of all, they're tiny. It's a $68 million company, and they have no revenue. So I don't invest in companies with no revenue. They had an IPO in 2021, and all of that IPO cash is going bye-bye. So look at this balance sheet on the right. You can see that every quarter, that blue bar, which is their assets, is going down because of the cash burn. The big thing that's happening right now is that they are delisting from the NASDAQ. So their share price fell below $1, and rather than doing a reverse stock split in order to maintain compliance, they've decided to delist and go and trade on the over-the-counter or OTC market. I personally do not touch OTC garbage, and here's why. There's less regulation for over-the-counter markets. It's harder to monitor these companies when they don't report typical SEC documents that I like to look at. There's also a lot less liquidity, which means it's way too easy to manipulate these stocks and send the prices going up or down. In conclusion, my favorite picks for autonomous driving today would be Allegro Microsystems, Mobileye, and Tesla. I think these three companies are making viable businesses today that also have a lot of prospects in the future. So to me, these are the least risky autonomous driving companies that can still provide a lot of upside in the future. Again, this is just my opinion and not actual financial advice. I hope this video is interesting to you. Please leave a comment down below if there's another theme that you would like me to make a video of. I hope you have a great day.